Now, if you're like most new traders, you're definitely chomping at the bit to get started in the penny stock game, learning the ins and outs of how new traders like yourself can get started as a professional. Well, in this video, what we're going to be doing is we're going to be showing you the good and the bad and how 90% of traders who start trading penny stocks blow out their accounts and how you can avoid those same mistakes moving forward. Hey there traders, my name is Kozak, founder of NSTA, and if you're looking for the world's best trading education and strategies, make sure you hit that subscribe button and don't forget to turn the notification bell on so each time we put out content like this, you can get results. Be sure to give me a thumbs up if you like the content so we know you're engaged moving forward. Now, before we move any further with this video, I really want to drive home the fact that the penny stock game is much different than all of the other stock market participations that you're going to be trading with. And the reason I say this is that the majority of traders that trade penny stocks fail, and this is why NeuroStreet and our live traders are completely opposite from the norm. Now, we're going to teach you the main concepts that are going to position yourself as an expert so that if you are interested in learning how to trade penny stocks like a professional, you're definitely going to be moving forward on the right foothold. Now, let's jump onto the whiteboard here. Let's talk a little bit about the key topics of today's video so that you can get ready to learn this stuff moving into the next segue. Penny stocks, deep dive. You need to know the difference between what penny stocks are and how they're much different than all the other stocks out there. We're going to talk about exchange compliance and how penny stocks go from being a penny stock into a normal listed exchange stock versus getting downgraded by the exchange due to compliance regulations. We're then going to talk about over-the-counter and over-the-counter bulletin board stocks and what their pink sheets are and how you can definitely position yourself knowing that stuff moving forward. We're going to go into the difference between broker markets and dealer markets so that you know the difference in the industry. And then we're going to spend some time going over stock splits so that you understand the cycles with companies between regular and reverse splits in the market. Then what we're going to do is we're going to end with one of the most famous topics on the street, initial public offerings, also known as IPOs, and the cycles that a business goes through in raising capital, initially basically launching an IPO, and then the reverse cycle that ends up diluting the stock and how you can avoid getting crushed in the market by stock dilution on a reverse IPO or a reverse split. So what we're going to do is we're going to give you all this information so that you are a professional trader moving forward and you do not become a statistic like the other 90% of the traders that blow out their accounts in the penny stock realm. Let's jump onto the charts. Let's get right into the deep dive information. This is definitely a video you're not going to want to miss. Take care, traders. We'll see you in the charts. All right, traders, welcome back to Stocks Explained Part 7. Now, up until now, we've definitely had a lot to discuss over the series of these videos. However, we're going to kind of wrap up the series on the intro to stocks by explaining some of the differences between the exchanges, the main exchanges versus the smaller types of exchanges, the over-the-counter exchanges. And I think it's a really good, interesting discussion because a lot of traders have heard of penny stocks. A lot of traders have heard of, these really low price stocks and understanding what's going on with them, but they don't really understand the industry enough to really have perspective. So if we're going to be a trader, it's good to know the ins and outs of all the different, components to the markets that we're trading. And this is definitely one of the discussions we want to wrap things up with so you have a good perspective moving forward. So let's talk a little bit about what penny stocks are, okay? Penny stocks are over-the-counter stocks. Some people call them penny stocks. Some people call them OTC stocks. They're very volatile, and they're not really preferred. Now, a lot of traders think that, because they're a couple pennies, they could go up 1 penny, and that's 100% return. Sure, that can happen. We could also go into a casino and hit a royal flush, and that could happen too. Right? So the concept is that it's very, very unpredictable, and they will make lots of big moves but are very dangerous. Now, based off SEC regulation, anything under $3 is considered a penny stock. And we actually trade stocks around $1.50, $2 and up. So technically, by definition, to the exchange and to the SEC, we're actually trading penny stocks, but we're not actually trading penny stocks because technically a stock that's less than $1 is trading in the pennies, so therefore we don't trade stocks less than $1. So really the baseline is we normally focus on stocks greater than $2. $1 is the minimum, normally $1.50. I just find the volume is never really there as much, and it really is hit or miss. So, and if if you're over $2, preferably they meet the listing requirements to be on the NSE or the NASDAQ, as these can get to the teens, 20s, and higher with news. And the reason for this is like you could have a $2 stock and then it could go to $10 very quickly in a very short period of time based off news. And we trade those stocks. So understanding the liquidity between the stocks, less than $1 or stocks more than $1 is very important. Because what ends up happening is, let's say you have stocks that are greater than $1, often will have spreads that are a penny. But when stocks have less than $1, spreads can be very, very big. If you take a look at this image, you'll see that as the market's trading down each tier of prices, the spread is just getting massive, right? Like you have a 22-cent spread, a 17-cent spread. As the stock starts trading down in price, you can see the price on the left-hand side axis here. Let me just show you. If you take a look at the price over here, we're going 53 cents, 52 cents, 51 cents, stock's trading at 50 cents. Then the stock trades at 45 cents, right? Take a look at this. We've got a 2-cent spread, a 4-cent spread, a 6 spread, an 8, a 17-tick spread, right? That's like massive slippage, right? Like massive slippage. And that's dangerous. It's very dangerous to trade a stock like that. And so you could get into the market and you could take a loss as soon as you get into the trade. So this is where you just need to be very aware of that. The liquidity drops drastically. And, and that's just really, that's 50% of the stock's valuation, right? If you think about it, if you're trading a stock that's 27 cents with the spread, okay, and it shows a 55. To me, if you think about this, it's you got a stock that's up around 50 cents with a 27-cent spread. That's 50% of the valuation of the stock, and that to me is just very dangerous. So we try to avoid that as best as possible. If you notice any of our scans that we have here, even on the small caps, because the strong gappers, you're gonna have smaller cap stocks. Take a look. You got a stock. I've got a stock $2, right? This stock here, the Dixie Group. This stock was $2, right? So if we're looking at this stock on a 5-minute chart, the market opened up here, traded sideways about 11 o'clock, and then it started moving up. Right. Well, this is, this stock here is, let me go back here and set this to the 5-minute. Okay. This stock here, it's going to have liquidity. It's not going to have the spreads that you're going to see in a penny stock. Right. And that's really why we look at these. Is anything less than $1, you start really seeing the spreads come in on these low flyers. And a $2 stock is not expensive. You could easily purchase shares on a stock and it can move and groove. Right, I mean, this stock moved from 170 to $2. That's a pretty big percentage change. It's 22% on the day, right? 22% stock, move is a very, very big move on the day. So, this is really interesting to learn this and to have that perspective. I'll share a little story with you just so you understand. The very first time I ever made a stock trade, it was a penny stock, and my best friends and I were in college, and we seen this ad. And I think it's really relative to this discussion. We've seen this ad for a jean company. And what was going on was this jean company was listing a penny stock. It was trading at like a couple cents, 1 or 2 cent stock, like a micro penny stock, right? And we seen, professional rappers on TV wearing the jeans. And we said, for sure, this stock is going to go to the moon. We've got these famous people wearing these jeans. We're going to get in right now. We're going to hit the millions, right? And what was interesting is we all put $1,000 into it. All of our buddies at school, we put our money together, and one of our friends put all the money into the into the stock. And then all of us were like kids in a candy store. We're going to class. We're like, what's the stock trading at? What's the stock trading at? And then all of a sudden the stock popped, and we were all up like $1,000. We'd made 100% return on our money. It went up 1 or 2 cents, and we're like, that's it. We're going to make millions. And I don't know what it was, but I said, I'm going to get out. Like, we're going to take our money and run. We've made 100% on our money, super, super quick. Within 1 day, we made $1,000 on a $1,000 investment. That's a pretty serious thing. As you're in college, making money, right, is a big deal. And one of my friends didn't sell. One of my friends, he held. He's like, what if it goes up again? And we all sold, and the next day it just went back to nothing, and he couldn't get out of the stock. There was no volume, there's no liquidity. He couldn't even exit the stock because no one could take the opposing side of the trade. So it was a lesson to be learned that, you know, you never know what you're getting yourself into until you're in it and you can't get out of it, right? And that's what we call a bag holder. You don't want to be caught holding the bag in a stock that you can't trade because there's no liquidity to trade it. And so that's a lesson to be learned about penny stocks. I hope you can learn from my own experience. I want to talk a little about exchange compliance moving forward with this. You know, the NASDAQ or the New York Stock Exchange, these are the big players in the room. The New York Stock Exchange requires all companies to keep their stocks above $1. If the stock falls below $1, the company will have to go through a specific time period to get the stock back up to $1 or more before they can delist it. Stocks are companies that undergo a reverse split. Like a lot of times stocks will actually do a reverse split to maintain compliance to stay on a big exchange. And a reverse split, you know, can hurt a trader depending on what happens. It dilutes the stock, but it keeps the price up. And so, you know, what we'll do is you know, we'll talk about this a little bit in a moment. We're going to walk you through the process of that. But in OTC markets, right, once a stock is delisted, it actually moves to an OTC market. And often stocks will be listed on the OTC markets and never become listed on the New York Stock Exchange. So some companies never ever want to go public on the NYC. You know, they'll stay on the OTC markets. That's a preference. Now there's pros and cons to that. So Pro OTCs provides access to securities not available on standard exchanges like bonds, ADRs, and derivatives. And there's less regulations. And you know, through the trade and low-cost penny stock, speculative investors can earn a big return on their money, you know, trading OTC stocks if you know what's going on. You see a lot of insiders trading OTC stocks, meaning like people that own shares of a company that work, you know, and they're investing in their own companies that they work for and stuff like that. And I don't mean illegal insider trading. I mean just a lot of insider activity that's people that are working for companies will get involved in the stocks because they know what's going on in the companies, right? And it's just a smaller environment. The downside of this is stocks have less liquidity, bigger spreads, less regulation, right? You know, they're prone to volatile moves and pump and dump fraudulent activity. You know, you see all these news is pumping stocks, and you know, it can be a very dangerous environment. So let's kind of talk about OTC and OTC bulletin board stocks. When you talk about a pink sheet or an OTC stock, it refers to the process of how the securities are actually traded for companies. They're not listed on a formal exchange, right? And so securities are often traded over the counter via broker-dealer networks. So this is a little bit different. It's on a centralized exchange. These securities do not meet the requirements to have being listed on the NYSE or the NASDAQ. And, you know, trade transactions take place through an over-the-counter bulletin board, OTCBB, or what we call pink sheet listing services. And the OTCBB is an electronic quotation and trading services that facilitates liquidity and information sharing, okay? So a pink sheet company is a private company that works with broker-dealers to bring small company shares to market. So stocks that trade on the OTC are typically smaller companies. They don't meet exchange listing requirements. However, they do meet other types of securities also, however, many other types of stocks trade here as well, right? It's not that it's bad. You just need to know the difference between an OTC stock versus an NYC listed stock, right? So stocks that trade on exchanges are called listed stocks, whereas stocks that trade via OTC are called unlisted stocks. And the OTC securities trade by broker-dealers who negotiate directly with one another via computer networks or by phone. The dealers act as market makers using pink sheets and OTC bulletin board, which is provided by the National Association of Securities Dealers, the NSAD. Now, this is really a theory lesson, guys. It's not really active in terms of how we trade our strategies because we're not trading over-the-counter stocks. At least we're not in the school. You won't see us ever educate on them. But it's something that you should know about moving forward because you're probably going to be around the dinner table one day or you're going to be at a barbecue and your friend's going to say, hey, I got these penny stocks. What do you think? And this is where you say, listen, I heard Sean talk about the dangers of this, right? Just have your own perspective. So this is a breakdown of a secondary market, broker-dealer versus dealer market, okay? So broker-dealers, okay, are national exchanges, New York Stock Exchange, Amex, Regional exchanges like the Boston, Chicago, National, Philadelphia, those are broker markets. So these are the big boy markets. Dealer markets like the NASDAQ or the OTC, NASDAQ is still it's still a big market. It's a dealer market. So NASDAQ is a global select, NASDAQ national market, NASDAQ capital market, and then you've got OTC. So it's not that, the NASDAQ is bad or good. It's just you need to know the difference between a dealer market and a broker market, okay? And so what I want to do is I want to kind of break down the 3 OTC markets that are kind of really where everybody kind of gravitates to is OTC market groups. You got the OTC QX, Pink, and QB. I'll explain it. The OTC Markets Group operates some of the most well-known networks, such as the Best Market, which is the OTC QX, the Venture Market, which is the OTC QB, and then the Pink Open Market. Although, if you think about it, why would a company want to use these? Well, some of them want to leverage capital. Some of them are trying to actually get listed for exchange and traded. Some of them are trying to do venture raises, right? Get a foothold in raising capital to grow their companies. So they go to these markets, right? There's nothing wrong with it. It's the process of doing business. But as a retail trader, our job is not raising capital trying to list on an OTC exchange. Our job is to trade liquid stocks that have a reason for us to being in them. So this is just about theory. It's about understanding them, okay? And, OTC networks are not formal exchanges. They still have the eligibility requirements, and you have to understand that, some exchanges do not list stocks. And I'll give you an example. The OTC QX does not list the stocks that sell for less than $5, known as penny stocks. Shell companies are companies going through bankruptcy, right? These are just things that you may or may not know about. OTC QX is the best market that it includes securities, okay, of companies that have the largest market caps and greater liquidity than other markets. So there's different tiers here, right? You've got the OTC QB, you got the OTC QX. And then you got the Pink. So through the OTC marketplaces, you can find stocks of companies that are small and developing. Depending on the listing platform, these companies may also submit reports to the Securities Exchange Commission, regulatory agencies, right? Just like other stocks. The OTCBB stocks will usually have a suffix of OB and must file financial statements with the SEC. Good to know if you're involved in those companies. And another trading platform is the Pink Sheets, and these stocks come in a wide variety. These businesses do not meet the requirements of the SEC. So you got to think about that. If they're on the Pink list, they're not meeting SEC regulation requirements. While buying shares of this nature may involve less transaction costs, they're prime for manipulation and fraud. So that's the whole point of this, is understanding, right? Pink Sheets are kind of like the Wild West, man. You're involved in it's like the black market, so to speak, but it's not illegal, but it's not really meeting SEC regulations. So my job here is not to scare you. My job here is not to kind of derail you from ever thinking about being involved in this. My job here is to kind of give you perspective moving forward as to why we trade the stocks we do, right? Why do we trade stocks above $2? Why do we trade large caps and small caps hitting high volume and high range? Because they're in play. All the professionals are trading them. All the big banks and the prop shops are trading them, right? We're not having to worry about all this stuff, right? So although the NASDAQ operates as a dealer network, NASDAQ stocks are generally not classified as OTC because the NASDAQ is considered a major stock exchange, right? So I want to walk you through the process of dilutions and secondary offerings because it has a lot to do with the small cap cycle, right? And every company that lists on a major exchange normally is going to start small and then get bigger. Not always will a company list on an OTC exchange first, but a lot of times what happens is that you'll list on an OTC exchange and then you'll move into a bigger exchange, and it's normal. And that's just coming from a company perspective, venture capital perspective. So a couple things here is it's about the dilution and secondary offerings. Everybody's heard of an IPO before. Normally, anybody that's in the stock industry has heard of an IPO. An IPO is what we consider an initial public offering. So the purpose of initial public offering is to get your stock listed on an exchange and raise money. The point of going with an IPO is to raise capital and to go public, or to go public, essentially, to raise large amounts of capital to grow a company and scale. It's part of doing business. It's the initial. It's part of the business cycle. Any company's got big vision is going to want to eventually go big public. That's just the point. And so the thing is, there's other involvement in an IPO. There's what we call a secondary offering and dilution and raising money. The purpose here, and I'll just explain this, is, a lot of companies don't just want to raise money once. They want to do several tranches. They want to raise money once and they want to raise money again eventually somewhere down the line. Or if certain things happen, then they want to trigger a second raise, right? So there's reasons for this. And so normally what happens, I'm going to walk you through this example. You start with an IPO to raise money, okay? So you have 10 million shares of float issued at $10, okay? It's 100 million market cap, okay? So they file an S3 shelf registration. Remember, we were talking about the SEC codes in the prior videos. They file an S3 shelf registration to sell 50 million shares on the open market in 3 years. So what does that mean? That's telling you right now, normally you'll read this in the S3. So when a company goes public, you can immediately go and look at the S3 file report to know if they're planning on diluting the stock. Okay? Very important as a swing trader or an investor. You need to know these things when they go public. So then the next thing is 5 million share secondary offering. So they issue a 5 million share secondary offering at $5 and they raise 25 million. The stock will then drop $5 price on offering. Now the float's got 15 million shares. So what they do is they do a secondary offering. They offer another 5 million shares, okay? And that basically increases the supply of the stock, meaning there's more shares on the open market to trade, which dilutes the ownership, which drops the stock price. They raise more money. Then they do a $10 million share secondary offering at $2. Another $20 million raised. The stock's dropping to $2. The float's now at 25 million. Okay, so as they keep raising money, what's happening is they're diluting the stock price. They're raising capital, okay? The stock drops to 50 cents over the next 6 months. Okay, so what happens is they raise a bunch of money, the stock drops to 5, it drops to 10. So originally it's $10, then it goes to $5, then it goes to $2. They keep raising capital, and then the stock drops below the NSYC, the New York Stock Exchange compliance listing requirements. So now what ends up happening is the New York Stock Exchange, they say, hey, Mr. Company, you need to undergo some operations here to get back on the New York Stock Exchange because you've breached our regulatory requirements to be listed as a public company here. And so what ends up happening is the company then does what they call a reverse stock split. So they do a 10-to-1 reverse stock split, and then that stock surges back up to $5 a share. Okay? So they basically now, what that means is now the float is way less. There's less supply in the market. There's 2.5 million shares available, from 25 to 2.5. Then what ends up happening is normally, and this is something that's interesting, normally what ends up happening is a company will release good news right after a reverse split, and they'll drive the stock price up even more. Normally a reverse split, they time it. They time these reverse splits around a major news announcement. Maybe they know they've got good earnings coming. Maybe they've got some type of something happening in the company. So they'll normally time the reverse splits right before a news pump, and they'll pump the stock so that you get a huge surge in valuation and then another huge surge in valuation again. And then what ends up happening is the stock price is so high again now that the company can go back out and they can do another raise on the secondary offering, okay? And they can raise more capital, and they can now bring in more money, diluting the stock price a little bit again because they've got a huger valuation, and now the float's going back up a bit, and that's just what happens, right? Now, this is the ebb and flow of the business cycle. You can't go back and do another stock raise. You're not going to go and raise money on another offering if your stock price is not enticing to investors. So what they need to do is they need to raise all the money, dilute the stock, reverse split the stock, pump the stock, then go out and raise more money from investors, and then that dilutes it again. And it's just a vicious cycle of the cap cycle. Like this just happens. This is the business. This is what happens in the stock market. That's what this whole. In fact, it's actually what these companies were planning to do from the beginning. It's not that it's not manipulation. It's not anything like that. It's part of the business cycle for raising capital. So some platforms will show splits on the charts. And a great resource for doing some stock research and to learn more about floats and filings and splits and shares is the bamsec.com or the SEC Gov Edgar site. We talked about that. So let's go take a look at the BAMSEC. So let's go. I'm going to show you what that looks like here. So this is a company here that will just give you more research on the stock. If you want to go and do company research, if you wanted to go and research anything, I don't even know if Apple is a good stock to do this on, but it's just tells you everything, man. Like this is just such an amazing website. It's just got all the filings, it's got all the reports, all the proxies, all that stuff, right? You can go to Tesla stock. You go in here. There's all of these different reports. If you want to search for a report, any keyword search, you want to go to an S3. I don't even know if they're only with, I got to pay for a premium site. So you can get the pay. If you want to do a lot more more in-depth, you can go on a free trial here, but this is a great website to do this. But it's really, if you're trying to do more research from a fundamental perspective, the whole concept here is that, when we see this happening, okay, you're going to see this on the gap scanners. So you're going to see a stock surge on like 50%. Like take a look, if we sort this, like, we got these 50% movers. Sometimes what'll happen is you'll see in here, you go down to the news and you'll go see what's happening on this stock, right? High Point Resource. You'll click on this and then and sometimes, forget what this says, it'll say reverse split, right? They're doing a reverse split, or, or news followed by a reverse split. Sometimes the stock will surge, and then a week later you'll see a reverse split and the stock will surge again. And so this is just something to be aware of, is that you're going to see this hit our scans. You're going to see this hit our scans a lot because there's reasons for these stocks to be in play. And that's the whole purpose of understanding this cap cycle, is that this is some of the reasons why these stocks move and groove. Right? And that's really important to know the difference. So it's not that you shouldn't be involved in any of this. It's just understanding the cycle of a company going through the stock market. So stock splits, okay? Traditional splits, understanding them. Let's say you have 1,000 shares at $700 stock price. With a 10-to-1 split, this will become 10,000 shares at $70, okay? So when you do a traditional split, what ends up happening is you're bringing more liquidity into the market in terms of shares. You're putting more supply into the market. When you have more supply in shares, you're dropping the stock price. When you do a reverse split, you're removing the supply of the shares, which creates more demand for the stock, and that's going to increase the valuation of the price. This reduces the float. So a split, think of the split as adding supply to the float. Think of a reverse split as reducing the float, therefore increasing the demand. Okay? It's very simple. That's all I want you to worry about on this slide. And I've already talked about some of this other stuff. It says here, an example is if a stock had a 10 million float with a 10-to-1 reverse split, this will now have 1 million float. Remember, just think splitting the stock increases the float. Reversing the split decreases the float. And float is always the supply of shares. Now, on a reverse split, there is a news release of some sort that comes post the split. And I've already explained this. And this is to help drive the stock price up massively so that it increases investor awareness so that the stock guys can go in and raise more capital for their business. And that's just about understanding the business cycle. And this all has to do with float. So that we're going to conclude the intro course on float, because the purpose of float has a lot to do with how well our stocks move. And the importance of float for account growth is that stocks with low floats create bigger moves. When we're day trading stocks, we want to have lower float stocks for the small caps. And for large caps, you're always going to have larger cap floats, right? And when an IPO is released, there's always a fixed amount of shares. This is the float. We always talk about this. And since we're all trading in this, okay, we want to know, what's going on with the supply. Since we're all trading the pool of shares, many times shares are purchased in big quantities by banks, makes them unavailable to trade. This is what we call institutional ownership. What's left outside that ownership is what's left for us to trade from. So whenever a company does an IPO, institutions will take on ownership of the stock, and then whatever's left is the liquidity in the market for market makers and stuff to go back and forth from, right? And so with less float means potential for bigger moves. We just need to make sure that the right time, the right place, etc., is for that. So float will always impact the volatility. It'll always impact the spread of the stock. It'll always impact the volume of the stock. And 3 ways float can change in the companies is share buybacks. So companies can sell shares on the open market. Secondary offerings, when company sells more shares into the market. Or reverse splits, when a company reduces the float and increases the price. So it's really important to understand float. I want to conclude the intro course by saying it's a lot of information to take in as a new trader. If you're experienced or you've had some experience in the stock market, definitely learn some things. I can assure you that. But I want you to feel excited. Okay, the purpose of this intro course is to get you excited to moving forward into now education on indicators and strategies. When you have an understanding of the industry and you have an understanding of all the nuances and the theory and some of the concepts around scanning and the main foundation, right? The main foundation of what you're doing. After that, it just becomes into technicals. Okay, so let me kind of conclude with this. Moving forward, our job at the school is not to really get you so concerned about all the theory. Our job is to basically get you good at using the platforms so that you can understand how to use the indicators and to trade to make an income. So if we're going to use NinjaTrader scanners, if we're going to use the NinjaTrader platform, if you're going to use the TC2000 platform, for me personally, I trade off the Ninja platform. So a lot of times what you'll even see is you'll see me duplicate this tab here. I'm going to duplicate this, and I'm going to basically float in a new layout. So let me show you what this means. A lot of times what you're going to see is you're going to see me have my scanners here. Okay? You're going to see me have my scanners here. And I'm going to be scanning for stocks, and I'm going to be typing on NinjaTrader. I'm going to be doing that because I like to trade off the Ninja platform, but I need TC2000 for my scanning. I need that. And that's just because I'm trading on these platforms, right? That's just my preference. Maybe you want to use TC2000, open up your account with them and trade through them. That's perfectly fine. Maybe you're using Thinkorswim. Maybe you're using Interactive Brokers. You're using TradingView. We've talked about that. But the purpose is to get you good using our platforms, using the tools. We have an orientation section for this. We have a training environment for this. We have an onboarding team to help you with this. But my job as an instructor and the instructors in our school and the other educators is to get you comfortable, right? Get you comfortable understanding what we're talking about. And then moving forward, we're going to teach you how to read the volume. We're going to teach you how to read momentum. We're going to teach you how to read the flag pattern here so that you understand that this is an ABC correction, breaking the apex so that you can time the breakouts. We're going to teach you how to read that. We're also going to teach you how to sort through the noise and look at some of the bigger picture volumes so you can understand what the institutions are doing. The institutions are looking at profiles. So the institutions are looking at this as a range of big business. They want to be buying cheap and selling expensive. So every time the big institutions can buy, they're going to buy. Every time they can buy, they're going to buy. So we're going to teach you how to read the institutional auction. We're going to teach you how to understand that. And you're going to learn how to read the daily time frames, how to understand big picture support and resistance, how to realize where the big key levels are and what's going on, right? So big movement moving forward. My objective is to teach you all the scans. You're going to learn how to use our gap scanners and our sector scanners, our earnings scanners, looking at correlation. I'm going to teach you how to read the correlation of the market so that you understand who's leading, who's lagging, what sectors are in control so that you understand all that. And I want to leave with this. We're all about keeping it simple. It may seem like there's a lot to learn in here, which there is, but we're all about keeping it simple. So at any time, if you need assistance with the platforms, with the education, with the indicators, moving forward, your next step is to get into our education classes and watch all the training videos in the education course. Then get into the strategies course and into the live trading room so that you can watch our instructors, myself included, trade. Hey there traders, welcome back. I sure enjoy teaching the content in the penny stock video, but rest assured that's not the only video in the series. Below this video, there's several links that break down all the deep dive training that we've done on getting started as an active stock trader, so be sure to check them out moving forward. Last but not least, make sure you hit that subscribe button and share this video with a friend. I'm sure they won't be disappointed. Moving forward, traders, I look forward to seeing you on the charts. Take care and happy trading.